Hi, everyone. Thank you for joining us today for the CQF Institute's very first Careers Talk. This is the first of what will be a series of events focused on careers from the CQF Institute. My name is Christian Figueredo. I'm from the CQF team. I'm talking to you today here from New York, and it's an honor to have you all here today. In a few moments, I'll introduce our speaker, Michael Althoff, who's joining us from Munich, as always, an international crowd, to take us through today's talk, A Day in the Life of a Portfolio Manager. In other words, a day in Michael's life. And what we have designed today is a highly interactive session. So if you have questions for Michael throughout today's talk, please put them in as soon as you have them. And unlike other CQF Institute talks where we hold them to the end, we'll try and get as many questions to Michael as we can throughout his talk today. So I mentioned that this is the first CQF Institute Careers Talk. There are really a number of other exciting career-focused initiatives at the CQF Institute that you should definitely know about. First is, and I think a number of you know about this already, our newly released careers report. This can be downloaded on the CQFI website. I strongly urge you all to do that. It's a very comprehensive survey of jobs and salaries really throughout the quant industry. Also, and now this next part is for CQF alumni only, we have launched a new careers clinic and a recruitment email service, which now lists hundreds of CQF specific jobs. So that's something great that we're doing for alumni. By the way, if you're a hiring manager and you're looking to recruit quants, let me know and I'll put you in touch with our recruiting office. Okay, and then as many of you already know, in addition to providing these talks, the CQF Institute is, of course, the awarding body of the CQF itself, which is the world's largest quant finance certification program. You can learn more about the CQF by, number one, visiting the CQF booth in the expo section of today's and the Hopin platform, where my colleague Tim Johnson is waiting there for you. So after today's event, I'm going to hop in, say hi to Tim, ask some questions about the CQF program. He'll be there. I'll be there myself as well. Also, our next information session, which provides sort of an overview of how the CQF program works, that's scheduled for June 7th. You talk to myself or Tim or register yourself at cqf.com, of course. Okay, so now on to the business at hand. Today's talk should last about an hour, maybe an hour and 20 minutes. We'll take questions at the end too, but as I mentioned before, we'll take some questions throughout the talk. And to enter your questions, use that Q&A panel you should see right there on the Hopin platform. But now, of course, it's my pleasure to introduce Michael Althoff. He's the head of ETF Capital Markets at Royalton Partners. Michael previously led the ETF Capital Markets Team in EMEA for PIMCO and was also fund manager for PIMCO's Real Return inflation protected portfolios. He is one of our distinguished CQF alumni. He has almost 20 years of investment experience. Really looking forward to hearing his insights on what it is to be a portfolio manager. And I hand you over now to Michael. And Michael, thank you for joining us today.
Thanks everybody for taking the time. Now, how should I put it? This is exactly the situation that makes portfolio management. You have your perception of something, you have your model, you have your view on the distribution, you think this or that security will follow, but in the end, nothing works. And you will have to adjust, you will have to find a way around it. So if you know statistics, what usually what you say is somebody up there, some call him God or whatever, he knows the perfect distribution, what we don't. And whatever you do really is try to approximate and have a go at trying to find out what the true distribution of whatever you're looking at is, but you never know, and things come in, events like this, and they might burn you out, and so you have to be prepared for that. And so it's actually a good introduction into portfolio management. Now I've managed portfolios for now, what is it, good 20 years. I did a master in finance in France, in Paris schools, specializing on finance especially, and then worked very early for an asset management company, PIMCO, focusing mostly on interest rate products, and that was for the first couple of years. And then Once you start getting into portfolio management, you will understand that you deal with a global network where everything is interlinked. In fact, you could say it's probably a stochastic network. It's never stable. Nothing is stable. And so when this talk was asking me to say, you know, what does a typical day look like? Well, a typical day never ends, because overnight the world continues. Somewhere somebody's making a decision. Somewhere somebody's adjusting something, and this will have an impact on you or on your positions. So a portfolio is simply a basket of securities that you try to manage in a certain fashion, either passively tracking an index, or apps as an active mandate trying to outperform a benchmark, or just an absolute return mandate, such as, you know, hedge fund style, where you try to find quasi arbitrage and make money. And these things are always impacted by decision makers across the globe. And this is something that you have to keep in mind. It's an interconnected world. You have to understand that you don't know the distribution, you don't know the probabilities, you try to adjust them. You have to try to approximate them as good as you can, but you can never be sure. This is something, this is a key takeaway that I want you to have from this talk. Now, this doesn't mean that you know, you should be afraid. It just means that you have to be strong in your opinion. Opinion meaning you want to express a trade. Let's say you have an active portfolio, you have a benchmark that you want to beat. You know, there's a certain security group that you think is not good, and you buy it. Now, you want to overweight it. For this, you need a certain mindset, you know, a will to do it, and a will to hold a position, a good argumentation, and we'll come to the quant part afterwards. But as I said, the world turns, and the world is globally connected. It's a global network, a stochastic network that always changes. So you have to be able to change your mind at an instant. You come up, you wake up in the morning, you read a newspaper, something happened in Asia, and you have to say, well, actually, what I thought yesterday and the assumptions that went into my model, in my well argumented, and it took me 20 days to program it and all the rest of it, it's probably false. And so that you have to be able to throw away past thinking and integrate something that is new. This is something that will dominate how a day looks like. This will dominate what kind of experience you need. This will dominate what kind of portfolio skills you need, and it also dominates what kind of other skills you want to have across your life. Now, let me start with a little bit of a background. So, as I said, I did my master's in finance in France, and worked interest rates in Europe. Then joined the real return team at PIMCO, working inflation-linked products, commodities, these type of assets, moving with inflation. But then I realized with the ongoing progress in financial modeling, I needed something new. And so I integrated the CQF program, which helped me keep my skill set up to speed. At that point, when I did my studies, I wasn't well versed in credit risk management, credit default risk modeling, those type of things. So I was keen on learning that, and I joined the CQF. Now, the CQF has changed over time. Now you have machine learning, AI, statistical learning, let's call it. Those things I didn't have in my CQF. And so I started in 2018 to do my PhD in mathematical statistics. And again, to improve my skill set. You know, there was over the last 5 to 10 years an abundance of data, abundance of real-time data. Large data sets that you want to reduce to the most important knowledge that you can derive from this data set. And so, as I said, if you think about a portfolio management position, how does it start? Well, you come in the morning and you have some position. Let's say you have an active mandate and you want to beat a benchmark, you're long something. The first thing you do when you wake up is you skim through a little bit, news flow, what happened overnight, who traded what. Is there anything that challenges my view, which I had yesterday, maybe formed qualitatively or quantitatively? Is there anything that challenges that? Then you look at your portfolio, you upload your portfolio, and you will have a portfolio management system where you can see your positions, the benchmarks positions, any deviations. And you want to see the deviations that you want and that you don't want. Any deviations that you don't want, you will have to clean out. This could be, for example, I don't know, you hold some options positions and the delta has moved for some reason, and the position that you wanted to have has moved away and you need to adjust. You didn't have possibilities to do this overnight, and you do it in the morning. So those kind of things are important. You need to have an operating system where you come in the morning, you see your positions. Ideally, they are produced overnight, and you skim through them quickly. Some people prefer on screen, some people prefer the printed out, but you go through and you have to, in any of your portfolios, you have to know by heart what you hold and why you hold it. For each and every position, I really want you to memorize this. You go through all of the portfolio and you want to understand exactly why you hold which position. What was my thinking back then? What was the portfolio management group's thinking back then? Is it still true? Do I need to challenge it? This is the first thing in the morning. Now something else might have moved, and any position that you hold is always relative to another position. So you might, let's say, take a simple example. You hold the S&P 500 and you think, the auto sector will perform. Okay. And you hold a slight long. And you have a certain expected return for it that you derive from some model. Now, something else comes in and looks like tech is better. But how much is tech better? Is tech more volatile? How does it compare? So any new day, you also want to challenge your existing positions with potentially new positions that you would like to hold, given their return, risk-reward profile. And lastly, you want to understand if those positions have a similar story. Maybe you're expressing the same idea with another name, but it's essentially the same thing. If I'm holding a debt security from some financial institution or its equity, the position will be somewhat related, you will agree. And so this is something you have to think about. Is the trade that I'm implementing the best way to express it? And here again, I want you to constantly challenge your own position. This is really key. You have to have some healthy paranoia. Every morning you come in, you look at your portfolio, you go through, you know your positions, and you think this is not right, this is right, this has moved, this is more attractive. This is homework. Basically, you come in, you do this homework. Now, the news flow might have come in, firstly. Secondly, the market moves. And so anything that you have in your mindset, how you see how you see the world, and this is actually how I went into portfolio management. I liked, as a personal habit, I like to think about imagining the world down here, another year, another 2 years, what could happen? And this is exactly what you need as a portfolio management. You try to imagine how the world could look like a year from here, 2 years from here, 5 years from here. And as you know, this is, again, a distribution which you don't know. Only somebody up there maybe might know this distribution, maybe not. You don't know it. You try to estimate this distribution as good as you can with some quant model, with some qualitative approach. And this is key, that you have this view, that you challenge this view, and then here comes the CQF or any quant knowledge in, that you take market prices and you derive from these market prices what is actually priced in. You might have the view that, yes, something will move, oil will move to XYZ dollars. But then, simple example, you look at the futures market, it's already there. You might think that oil will start to rise from here, but if it's already priced in futures, it's not a good trade, right? You might, let's say the futures are at 150 and your whatever perfect model you think shows you 130, you should be shorting futures, even though you think it will rise, right? So this is something, again, that you have to keep in mind. You are thinking about the world, you're imagining how it would look like, given your econometrics, your modeling, etc., etc. You have some forecast, and out of this, you try to back out the prices that are already embedded in market, in options markets, in credit markets, in yield spreads, etc. Once you've backed this out, once you've backed out the probabilities in the market, right? It's this whole talk about the Q measure versus the P measure. Once you've finalized this, then you can start implementing trade and comparing trades. Now, the good thing that we have nowadays is a vast amount of data that gives you a much better apprehension of where things are going, at least for the short term. There's very good data now available to do nowcasting. When I started, you know, we had rough ideas where growth is going. Now, with the data available over the last 5 to 10 years, I can do a pretty good nowcast, even though that economic data is usually printed a month later, a quarter later. We can now have a pretty good understanding where the world is going currently. And so this is a very important skill set that you combine financial modeling, financial pricing, deriving forward prices, deriving implied distributions from options market, deriving implied probabilities from credit markets, and then you compare them to your other side of the skill set, which you have acquired in the quant space, that is nowcasting and forecasting where the economy is going, where then inflation is going, etc., etc. Right? And so this is again key. You have you try to have an idea about where the world is going. You don't know how it's going. You just have an assumption. You compare it to market prices and you go for the best risk reward trades. This is essentially portfolio management. And this really drills down to any asset class, really. Now, there might be some differences. You know, in equities, you look at high beta, low beta stocks. In commodity markets, probably similar. You also try to cluster them, you know, precious metals and agri, etc., etc. In credit or in interest rates, it's a little bit more complex. You have an interest rate curve that is stochastic, that is interlinked. You have various default risks. You know, you have junior debt, senior debt, etc. So these kind of things make it by the respective markets a little bit more complicated. Now, my current job at Royalton Partners actually covers cryptocurrencies. So we're trying to build a portfolio that tracks a cryptocurrency index. And this index we developed at the Humboldt University in Berlin, where I did my PhD. And it takes about 850 investable non-asset reference coins, so pure cryptocurrency, let's call it, or governance tokens, this type of thing, and reduce the set of roughly 850 cryptocurrencies to about 15 or 5 to 15 that represent the overall market, right? And then we try to track that index with portfolios. Now, this is again a combination of skills that you have. Dimension reduction is very important, and trying to think about how you can structure a portfolio behind it that allows for liquidity, etc., has to be in it as well. Now, in a perfect, like when you write research papers, often what is neglected is implementation. Often what is neglected is liquidity, good liquidity. So very often you will read papers and think, you know, okay, in hindsight, this is something that you know, I should have known, but you know, in a research paper you get there, but in real life you don't, right? Because at this moment you don't know. So this is something that you have to really internalize. Now, I see a question popping up here. How was the crypto portfolio weighted? Well, there's various ways to weight it, and here again, so there's a technical way, a quant way to weight it. Let's say essentially the way we do it is we take the overall 850 cryptocurrencies and derive an index which has a certain distribution, and we try to match that distribution. That's how the weight is derived. But as a portfolio manager, you can never simply take a piece of paper and implement it. There will always be something in between. legal side. Can I invest in them? Are they seen as cryptocurrencies? Are they seen as more financial securities, etc.? Can I warehouse these coins? Which banks can I cooperate with so that they do, hold the cryptocurrency wallets? Where should they be held? Who holds the keys? Is this process accepted by the regulator? So the portfolio management task is not only thinking about the world and pricing the world and deriving underlying prices from markets, but it's also sometimes and very often a technical approach. And so this is a part of the daily task as well. As a new coin comes up, it's important. Am I allowed to hold it? So I see another question. Roughly, what is the percentage between optimization, mathematical modeling versus intuition, news? So I can say intuition. I would make a distinction between intuition and news. Intuition is probably, I don't know, below 5%. I mean, maybe have a very strong intuition, but I would say never say. People confound portfolio management with somebody having a good view, intuitive view, and I'm sure there are investors like that, but usually what you do is it's a very homework type technical approach. You look at markets, you build a good model where you have an understanding of the deviations and of the you stress test your model basically on robustness. And once you have a relatively good view where you think the center of distribution of something is, then you derive mathematically the underlying embedded price for that, whatever you look at. Let's say you take an option. Let's say you take an option market for Fed fund futures. So essentially looking at will the Fed hike or rise, and you have a view that that they need to hike. They definitely need to hike by 50 basis points. Then you can derive first of all the futures for those respective dates, as well as the option markets, which gives you distribution around it. And if your distribution is higher or lower, then you have your trade or not, right? So it's a very technical approach usually, portfolio management. The financial risk meter, do I use it in my day-to-day? So the financial risk meter is a paper I've written, which tries essentially to capture dependencies in tail events. Usually we took like 5% alpha or so, or 10% alpha kind of distribution, if you just think of a very risk type approach in a network setting. So we try to see what are the interlinkages. So let's take a simple approach. You run a regression, and regression is a linear model, but your regression is never stable. Your correlation is never stable. Depending on the scenario, your correlation can jump to 1 or could jump to -1, depending what it is. And this we try to capture with the financial risk meter. It's a paper I've written. Now, I do use it because it gives me a network setting. As I told you, the world is a global network, and the network is stochastic. It moves all the time. But you try to have a little bit of an insight into what moves with what and why. And once you've understood that there are two banks, for example, they always move together in a stress scenario, you try to understand why qualitatively. This is the last approach. Yes, you can do a lot of things with quant approach. You can do have decent strategies, systematic strategies, but the extra touch you will always get if you put a qualitative overlay. Let's say some security trades cheap. I remember my first job was as an intern, and I had to model like a systematic approach to invest in equities, and for a very big financial German insurance company. And suddenly there was a group, like a cluster of cheap equities, and the head of the department just went, yeah, of course, this is asbestos cases, right? So they had a lingering asbestos case, which was priced then in the market, and they popped up as cheap. But if you were fully to trust your model, it kind of give you a good direction. But qualitatively, you would have to read the newspapers and understand. So when you say, is it more mathematical modeling versus intuition? It's not versus, it's basically including the news, right? You have to understand the news flow, something is drive. So the morning you wake up, you know your positions, you read your newspaper, you question yourself, and then you reposition or you keep your position. Intuition is very seldomly in there. Now the financial risk meter has gives us some ideas about linkages, and for that I never wrote this in the paper, but we use it for some of those approaches. Yes. What are some common sources for research papers. How does the review of these constantly factor into your day-to-day? So the research area has moved, and I would say especially over the last 2 years with the COVID pandemic situation, but already before. A lot of papers are already pre-printed, not peer-reviewed yet, pre-printed. You can skim through them and you get an idea what they want. So the task for you is to have a good knowledge, a rough knowledge of what this paper is about. If you read something, you haven't seen this model, there's so many models that, you know, it doesn't matter. You just take a book and read up on it and try to capture the essence of the paper. And I would say on a day-to-day basis, it probably doesn't matter, but it will pop up. For example, we wanted to construct an index to track NFTs. And there were some nice approaches stemming from a very different sector that I looked at. And I had to take the paper. Basically, I went through, and you know, on archive.com and so on, .org, you can find a vast amount of papers. You have to be fast in like cross-reading, understanding the main idea, and then you take the important ones. You dabble around. You try to see if any of those models make sense for you, and then you go forward. So there's and this you do with an approach of knowing any model I apply is never the true one. It's never the true one. Again, you never know the full distribution, especially not in a network setting, especially not in a stochastic network setting. You will always have to question yourself, but you try to have some ideas, some estimators that are maybe they look robust, and then you base your decisions on those. Right? This is your task. Find the little estimators that are robust, that are not moving every day with, you press F9, it's completely a different portfolio, make it robust. And that's basically how these papers, they do factor in. And I think in your day-to-day experience, it's important to sometimes skim through. It's good to take half an hour or so, just skim through if there's anything of interest. Be logged on. I have one email account where just research for certain topics that I like come in. I look at those and I follow those, right? And so in the overall portfolio skills that you need, I mean, with the CQF, you're already, do I use core integration? Yeah, we do use core integration as well. Yeah, so it's probably a better way to do it. Yeah, but I was just giving correlation as an example, because often trades are based on correlation, but it's obviously a linear measure first of all, and then it's never stable. So yeah, with your CQF skill set, you are there already. You know how to model this, and I've seen the what you've learned, and I've logged onto some to keep up to date with you guys. Actually, I did my CQF. I think it was 212 or 211, something like that. Right. So things moved ahead, and you can see the world is the skill set that you need today is much more different to the past. And so it's very important that you keep up to date and read. So again, do the investments you manage have a standard time horizon, or is it strategy dependent? Yes. So portfolios can be anything. There are portfolios with a very long-term view. Let's say a life insurance account, and you think about how could the world be in 30 years. Then it goes back to really macroeconomic modeling. What is my potential growth? What is and from that you try to derive inflation. Then you get some idea of where nominal rates should be, and then you know what to discount all of your projects with. So there can be very long-term ones. There's sometimes very short-term ones. There's portfolio management skills where you have somebody who just wants to park his working capital or money that he needs for that, maybe for 3 months. And so you have a portfolio where you have to always roll, like, you do very short-term investments, and they have to either unwind by themselves, so you have the cash to repay the client, or it's easy to unwind them. There's others, you might have an equity position that is geared for 15 years, so you have long-term positions. So you do your quant modeling, but you also want to read then, in detail any of the not so disclosed items. Let's say you have British Telecom, you want to understand what the pension scheme is doing, those type of things, right? So it's really How do you work with stops? What measure do you use, VAR or CVAR? So, value at risk is a simple approach. Don't use it much, to be honest, but we need it for reporting. CVAR in a bivariate setting, maybe you might look at it. Usually you have stop losses that you set. If it depends on the portfolio, right? So let's go back. You have a passive mandate. You shouldn't have, you shouldn't deviate much, essentially, right? You'll have some smart passive where you optimize around rebalancing dates and those type of things. But no, active positions, you will usually have an active position, and you will have an argumentation why you hold this position, and you will stop this position as soon as this argumentation is no longer true, or if you doubt it. If you doubt it slightly, then that means mentally your distribution assumption must have changed, and then you have to compare it again to market prices if they moved again, and you readjust the position. So I think about those terms. But yes, CVAR and VAR, they come from the regulatory mindset, and we have to obviously follow those, but it's usually let's call it an argumentation that you have with yourself and with your portfolio management group of whether the argumentation for a trade is still true or not. Behavioral finance or heuristic in your modeling, sentiment analysis. Yes, actually. So I did. So when I did my PhD, we had to do a presentation which was outside of our study objects to broaden our mindsets, and I did it on sentiment analysis. And here, what I did is I took central bank communication, quarterly communication or monthly communication, and I built a sentiment model which tells me whether or not a sentiment is positive or negative versus a certain topic. So you first of all have to identify topics, and then you have to see if the phrases around it are positive or negative. Exactly, yeah, NLP. And so somebody asked the question if that was using NLP. Yeah, so basically in that direction, right? So we in this setting we did, because in economic research, the phrases there's hardly any jokes or satire or something like that, right? It's or sarcasm. It's very straightforward text, so you can use basically pre-qualified phrases and match them. So that's what the heroes do, and that's very fast. And so yes, this is something that you do, and you see sentiment indicators. So if you see a central bank moving more and more towards the positive space on a certain topic, let's say inflation, and the inflation market is not ticking up, and also in the option markets on inflation, there's not a distribution that says, well, there's more upside implied in the distribution from options, then it's a trade you want to put in. It's an extra input, definitely. Yeah. To my experience, the relatively easy part is to create a good forecasting model. However, the art is to know when a model stopped working. How do you decide when it's time to replace a model strategy by a new one? Yeah. So this really goes back to your healthy paranoia. You can use a model, but as soon as you see it's first of all, it's jumpy, it's not robust, it moves with slight moves in what you think or what by model standards shouldn't be important measures, then it's probably not a good model, right? And so it's usually when your model moves too far away from reality afterwards, then basically yeah, so you have to throw it away, or you have to adjust it, or something is wrong. Now usually you backtest it, right? And you have to create a backtest is an important step, and you have to really be honest with you when you do your backtest. I know that it often takes a lot of time to build a model, and you're very proud of your model and you really like it and it makes beautiful charts. But when you do your backtest, make it really honest, input as much as you can, liquidity and how fast you would be in making decisions on that, but be very honest, and then do your backtest based on that, on those constraints. And once if this constraint gives you a rough good measure, still, relatively good model, and also beats probably the forwards or whatever is derived in the option markets, then this could be something that you use. This is how I go about it. But if you see that the model that is not working, you have to be You have to be somebody said it's you have to be a little bit psychopathic. The human mind has a lot of biases, and it's good to read about biases. This is something somebody asked about behavioral finance. So one of the important things that I take from behavioral finance is biases, and you work on yourself, you understand the biases, and you try to delete them as much as you can. So if a model it doesn't work, you throw it away. If a position, you see it yesterday, you really liked it, and you had a big fight with your boss, and to convince him, he said, yes, let's put something in. The next day something comes in, you go to your boss and say, no, sorry, wrong trade, I have to take you out, slight loss, but trade is no longer true, right? So this skill set you have to keep. This is the best. What is the best strategy for a risk professional to move into PM? Yes, it's important. So usually, there's two types of portfolio management companies. Some where the portfolio management does everything. So he has portfolios on equities, bonds, commodities, whatnot, and others which are more concentrated on markets. So you have a specialist in a certain sector, let's say commodities, and then he analyzes this. And so it would be, and usually a position that is hired into that space is somebody who's traded maybe commodities at a trading desk, or was somewhat involved, or was an analyst, or something like that, understands modeling. And then you move, usually as a junior position, you move in, depending what it was, you move in as a junior position, and then you add skill set, and then within that, usually you will be tasked to compare your trade that you propose to other trades from other markets in this mindset, right? So somebody proposes something from equities under some argumentation, and you say, no, I actually have the better trade. We can express this idea, economic, whatever, political, with something else, right? And so this is when so essentially something that you need to understand. What type of asset manager is it? And then this is how you apply. Usually you have a specialist position and you get into it for a specialist role, for a specialist portfolio management role. How is financial statements analysis considered nowadays, and so on? Yeah, so I mean, you have to think that there's so many financial statements coming out every day that it's very difficult for most companies to keep track. And here again comes NLP and so on. You try to build machines that read them. So they give you analyze by topics, you try to understand if it's positive or negative, and you can already see. So another model I built out of the sentiment model was to see the equity price and also the analyst recommendation from various banks. And you can see the sentiment dropping, and then later also rate cuts and so on and so forth, and then underperformance. So this is something that is important, but largely there's so many companies out there that you won't have time to read all of them. However, the positions that you hold, that where you have an expressed position, you should know by heart. You should really understand how this company functions, why it's better than others, what are the statements you should dial in, and okay, there's maybe one point, somebody mentioned intuition, there's maybe one point where intuition is important, is when you follow analyst calls. You might have a feeling if if this CEO or CFO is straight or not. In terms of his communication, and actually there's a quant company, if I'm not mistaken, they were from Munich, who record the messages, and they give you just by the voice, they can tell you if he was believing his own thoughts or not. So this is I would say could be important in future as well. There's structured data. We've all known structured data in nice table form and easy to analyze. And there's a lot of unstructured data. I would probably put financial statement analysis in there as well, and also conference calls, CFO calls from a company, which you try to structure. And all of these sentiment models are essentially that. How automated are your quantitative trading investment systems? By the sound of it, they are fairly manual after you have taken your modeling and daily into account. No, so there's two ways. There's let's call it robo type approaches, where you build your model and you developed a strong belief in your model by whatever way, and then you just auto run them. I have a preference to have a manual override, because again, your model never represents the real world. The real world is always, it's an approximation of it, but it's never the true world. You don't know, is my tail approximation, is this correct? Maybe the tail is much thicker. and that's usually the case as an example. You know, your correlations jump around depending on economic scenarios. So yes, you can be fairly systematic, and I've been and we are fairly systematic in our approaches, but I would always say question your assumptions. In every model there's an assumption. You have to understand your models. What are the assumptions? Distribution, you know, you do a neural network, there's somewhere an activation function ReLU. This is an assumption, right? Why do you use this? And this could have an impact on your results, for example. So it might be the right choice, but just have this in mind. Really understand. Don't take just a package from, you know, R package, or I don't know, some Python package, and run the numbers, and something comes out and you don't believe it. It's you have to really understand why. What distribution assumptions, etc., etc. What modeling assumption? What window? This is really, really important. So in terms of daily market intuition, no, you have so again, you build your portfolio, you compare your thoughts versus what the market says, and your thoughts could be derived from a model, right? I'm not saying this is a qualitative approach, it could be a quantitative approach. Your model says buy this, okay, and then you compare it to market prices, right? Or your model should already be doing that, but still you want to question this and, you know, do a quick search. Is there some news flow going on? Is this cryptocurrency? I don't know. Is there some fork? Is there I don't know, like an airdrop? Is there, you know, is there anything related that I didn't know, and why does it pop up, right? So these kind of things is important. And there's no good or bad approach, which is why there's a vast amount of asset management companies or portfolio management companies and services. There's you know, very different styles, long-term, short-term, and so on. Are you able to divulge some of the technical program libraries you use or have used around Bayesian statistics? Yeah, exactly. PIM3, I know you still need tweaking to handle certain assumption models. Can you confirm? Yeah, so I've used Bayesian statistics a little bit, and on Python. There's a really good researcher. His name is Vierki, and so I found it interesting actually in looking at this now, and it's just so the Bayesian world has its reason, because you often have an idea, like you know, it probably goes into the way of the question of intuition. You have an idea of the distribution, so somebody asked if I can spell the name. I'll quickly spell it for you. Let me see if I can send it to everyone in meeting. Out of my memory, it's like this, but you know, yes, I think yes. Even he was a PhD researcher. I invited him to some of our conferences. It's relatively hands-on. It's quite nice, and there you will get a very good grasp on if this topic interests you. But again, yes, so tweaking, I would say tweaking means, you know, you want to understand the how the model functions. You know, you throw in some change data and see how the model reacts, right? And this will give you a good intuition of the model. But always, like, you know, you have to really go through the package, what he did. Often there's shortcuts. There's some implicit assumption that somebody made. You have to understand those, because if you write an economic paper or a master thesis or whatever you do, you know, chart is wrong, you can replace the chart. In portfolio management, you make this decision, you invest, and it's based on wrong assumptions, and you know, you might be losing a lot of money. So you should understand your models. Now, this is another thing. If you come across a portfolio management company and you have the idea they made a good performance, but they can't explain why, then this is not a company you want to work for, even if they have positive performance, because it could have been going the other way, right? So, and the same goes for you. If you work for a portfolio management company, you always have to have an argumentation why something should be going a certain way. And if you make a certain performance, you should be able to explain it. I bought this because, you know, my underlying quant model showed me market should be there, or in relative terms, this has more default risk than the other one, or priced in and whatnot, right? And then you, based on that, the market can still move away for whatever reason, flows and something like that. But this is something you should be able to explain positive performance as well as negative performance.
How you doing, Michael? So I'm sorry to derail you because you're getting all of these great technical questions, but we had Shrey ask a question, actually sent it to me directly earlier. I wanted to open it up to more of a general sort of question. As you see it right there, Shrey works in strats. He wants to become a PM. He provides some other details there. Maybe you could comment on that.
Yeah, okay. Now, so if you work as a strat at the bank, I mean, this is already something that goes towards portfolio management, because in essence, what you do is you try to derive investment strategies for your portfolios, or for your specialist market that you want to implement for yourself, for your colleagues, for your portfolio management team. So this is something that you could take. Now, you say you work in implementing dynamic index strategies. I don't know. This could mean various things. But there's definitely shops, portfolio management shops, which try to have exactly that, right? They want to have a systematic approach, machine-based approach that is time-tested, robust, robustness test, and then they implement and offer it to their clients. So you have a way of definitely having this step. Is it tough? It depends on your. So if let's say you would come to me and apply for a position. And then I would skim through, and you should be explaining, or your first page of your CV should pop up and tell me, yes, this is exactly, he has derived strategies. He understands how they should be derived. He understands the weaknesses of his models. And this is basically your game plan for interviews. Yeah, so this would be my answer. I think it's a good way. Is it tough? I don't know. It really depends on what is being searched and what you can offer, obviously, right? But this counts always. But if you can make your specialist position, if you can design your CV in a way and your messaging in a way that attracts this type of investment management company, I think it can work. And something to remember is that CVs, when I started, CVs were very technical, dry, and products. Nowadays, they are much more about storytelling. So when I write a CV, for example, the regulator needs it or so, it's much more storytelling, right? Where am I from? What have I learned? Where do I want to move? What skill sets do I have acquired? What skill sets am I working on? What is the direction I want to go, and why do I fit with your company? This is basically it. So it's a lot about storytelling, right? And try to tell that story to yourself a couple of times, and then you'll be far ahead of the pack. I hope that helped. Yeah.
Oh, do you have some? I was just going to offer to
yeah.
To get you have just some more questions there, so I'll leave you to it, Michael. There.
Yeah. Is a PhD in a quant subject necessary nowadays? Would you recommend it? So your second question is about work-life balance. If you have more work than balance, then you're good to go. If you have family and other necessities and hobbies, then maybe a PhD is a bit difficult. So I did my PhD. I have a family. I have I had a new job coming up. It was tough. Now I would say in nowadays world. So why did I do it, right? Why did I take that pain? And if you do an external PhD, it can sometimes be a pain. So for example, I have to finish a paper by 31st, so next week. So it's actually Asia hours, so it should be like Monday we should hand it in. And we wanted to have actually the last crypto sell-off we wanted to put in as well. So we updated all the models, right, which takes time. So you'll be sitting sometimes, if you work, you sit at night essentially. So you have to be a little bit tough sometimes and just pull through. But I would say,
sorry about that, Michael. Just wanted to hop in there. and there's really general point to make about PhDs. It really depends on the role that you're applying
Exactly.
for,
Yeah.
right? So that's like some people are going to say you need a PhD for this role. Increasingly, I mean, but that's how like 20 years ago, the only people that called themselves quants had PhDs in fluid dynamics, and that was your quant team. Nowadays it's almost more democratized. So, the CQF is going to be appropriate for a ton of quant roles. But yeah, of course,
Exactly.
there are some positions that they're going to specify PhD. So it really depends on the shop you're working at, what you're going to be doing. CQF versus CFA, we can talk, Alessio, that's a great question.
If
Yeah,
I could
sorry.
chime in, something I would like to say is, and this goes back to the to the story you want to tell. It's a lot more about skill set. I prefer somebody who knows how to program and understands the modeling. He doesn't need to have a PhD. A PhD is something, maybe it gives you a stamp that you've done it, but actually, if you can prove your skill set, this is much more important. And actually, when I go through CVs, if people apply, I go through skill set and story they tell. So this is basically.
So, Michael, we're going to wrap things up right now.
Sure.
Still a lot of great questions coming in. Sorry we couldn't get through to all of them. I don't know, folks, Michael, if anybody wants to stay in touch with you, how do they do that?
Yeah, exactly. Yeah, they can find me on LinkedIn. Just
Okay.
drop me a message. Yeah,
Very
easy.
good.
Yeah.
And folks, and Michael, thank you for being with us today. Folks, everyone,
Absolutely.
Thank you so much for joining us today and for moving over from Hop into this platform. Much appreciated. From the questions, seems like you folks got a lot out of this. That's great. If you haven't downloaded the careers guide, please do. Valuable resource, especially if you're looking to explore other options in quant finance and career-wise. And if you haven't earned the CQF, feel free to definitely come to our June 7th information section. You feel free to reach out to me. I'll Christian Figueredo, or just go to the website, and a ton of people can answer your questions about the CQF. But thank you all so much for joining us today for our first careers event. Sorry we had a couple of glitches. Thank you all for joining. So take care. Bye-bye.
Thank you very much.